All right, welcome back, everyone, to the Financial Philosophers podcast. Danny, good to see you again.
You as well, Chris. Hope your day's going great.
It is. I'm excited about this topic today. It's one you and I have talked a bit about off of mic.
That's true.
And it seems to be all the rage. A lot of people talk about this.
It really is.
To our listeners, today we're talking about passive income, right? And for many people, there's this big question mark of what the heck is passive income? Like, what does that mean? And I'll be honest, even as a financial planner, I've noticed a few things that don't always add up or make sense. This term is used pretty broadly. It means different things to different people. And I think today we want to open this up a little bit and explore what passive income is, different ways you could view it or think about it, and how it may apply to your own personal financial journey. I think to kick off, there are different ways you could define passive income. The first way you could define it is by the IRS tax definition, which is a very technical definition. There is something called passive income in the eyes of the IRS, and that could get into things like passive activities, limited partnerships, things like of that nature. That's not what we're going to talk about today. So just planting the flag right now, for the rest of this episode, when we're talking about passive income, we are not thinking or factoring in any technical definition regarding taxation or the IRS's definition of passive income.
Okay, that's good to know.
Right.
So we're going to look at more the layman's term, passive income, and kind of the way that you see the term passive income thrown around very broadly and very vaguely in literally every financial arena of social media.
Yeah, I mean, it's all over the place, right? And like for the regular person, when you hear the term passive income, literally the terms passive and income are used very loosely here. Like there's no consideration about...
A little too loosely, I would argue. A lot of things that people say, this is passive income, it's going to be great for you. Not as passive as they might put forth, or not as passive as you might hope once you actually get into the weeds of this stuff.
You're absolutely right, and we're probably going to shed some light on some of those examples in a little bit, but that is often an area I laugh when people talk about, do this as a good source of passive income, and in my mind I'm immediately like, I don't know if you realize just how much involvement that's going to require.
Build this business for passive income. It's only going to take you 57 hours a week after your full-time job, right?
Yeah. So it's funny, we laugh at it, but it's important to be mindful of these things, right?
Yeah, we're going to dig into the differences for sure.
Right. And so for most people, this passive income idea is more or less, it's just, hey, I want this source of income that requires little to no involvement or effort to give me income to be able to support my living needs, right? It's kind of going to the old traditional getting money working for you, so to speak. If you will.
But it's that idea of having money that makes money while you sleep, or finally being able to separate your income away from your time, right? So most of us, we work for a wage. We are selling our time and labor for income. So I would argue a lot of people, that ultimate goal and that dream is to separate your income from the sale of your time.
That's a really cool way to put it. And I particularly like when you said for the sale of your time, because I think time is really the important factor here, right? So like, I think this is where passive income applies to most people and why it matters to them, right? Like, because like you said, Danny, almost everyone aspires to rely less on their job, right? And that could mean different things. For some people, it could literally mean retiring, like entirely stepping away from your job and being able to just have complete freedom and free time to do what you want and be able to have some sort of passive income to support that. It could also mean somebody who just wants to step back from their job a little bit, maybe work part-time or just have less involvement. And so building up some form of income that is quote unquote passive could enable them to step away and not have to rely on their job as much. For others,
Absolutely.
it could just be having the FU factor, right? It could just be like, hey, I want enough of a lump sum that could produce a high enough passive income so that I know, at least just for my own, I don't know, mental health. If I ever need to step away, I could just say F you to everything. I'm breaking off. I need a little bit of time. I have enough passive income that can support me.
I
And
will say I'm generally trying to be a little bit less aggressive than that. However, I do have a passive income portfolio separate from my other accounts, and we'll get into that a little later.
Sure.
But for me, one of the aspects is a safety and psychological effect and benefit, right? My current goal with that one passive income account is to get it to where the passive income will cover my mortgage. And so that's my current goal. The thought being that, again, if anything crazy happens, loss of job, income, crazy medical emergency, etc., that I could turn off that reinvestment function and use that income to, in an incredible emergency, pay for my mortgage if needed.
Yeah, that's a very motivating goal, right? You've set that goal, and you now have a tangible thing that you can tie that passive income to. And I think we may explore what you just described more in just a little bit, but I think it's that kind of aspect where people can tangibly tie it to something real in their life that often finds themselves being very motivated by this idea of passive income. So, you know, not to get too nerdy here, but like retirees, for example, eventually quit their jobs and hope to replace their income with other sources, right? And we call this retirement income or retirement planning. At least financial planners call it that. But when you really take a step back and think about it, like, are retirement income and passive income really so different? I'm not so convinced that they are. I'm becoming more convinced that the term passive income is just what the cooler, hipper, younger working person's generation has come up as. It's their flavor of quote unquote retirement income, right?
But I guess to me, in terms of passive income, what that would represent when you're talking about someone that's retiring, the only difference that I would see is if someone who has retired has a portfolio and they are actively selling shares in order to fund their lifestyle. That's the one thing to me that on the surface doesn't feel like passive income. For me, passive income, at least in terms of market investment, revolves around not having to sell shares in a company and living off purely dividends or other sources of revenue, essentially.
Right. And, you used a good word there. To you, it doesn't feel like passive income. And I think this ties into the broadness, if you will, of the terms passive income being used loosely. I think there is a subjective element there, right?
Sure.
To me, like, one asset class that, oh my gosh, you do any Googling, you listen to YouTubers or TikTokers, rental real estate, which we'll talk about in a minute, is often thrown out as like this great source of passive income. But to me, I don't feel like it's really passive income because there's a lot of work that goes into maintaining a rental property. It can
certainly be a good source of income,
right?
Particularly if you manage to get into it a couple of years ago with nearly 0% interest rates. A little bit harder to do in the current rate market and environment.
Right.
However, I would argue that is anything but passive. You have to manage relationships with renters. You have to manage the care of the buildings and repairs, taxes, insurance. It can, in many ways, become a full-time job in and of itself. So I would argue people might say that's passive on the surface in order to sell you a course or something, but it is absolutely not a passive investment or endeavor in any way, shape, or form.
I agree with you in on many things there. I think maybe this is a good time to actually jump in to what some examples of passive income are, right? So Um, we'll start with rental real estate. That's a really popular one, and a lot of people will champion rental real estate as a great source of passive income. So let's talk about some of the pros and cons really quick first. So some of the pros, you could, in theory, it requires a lower upfront payment, right? You could make a, a 20% down payment on a rental property and then immediately start renting it to tenants. And the
Now,
amount of rental
just to clarify, when you say a lower upfront investment, you
right.
mean in relation to what's required for, say, dividend investing, that lump sum, because homes do still require a large initial investment of capital.
You're exactly right.
Okay.
Yeah, let me give you some easy numbers I wrote down here. So let's say you bought a $300,000 home and you just made a 20% down payment, which is $60,000. And then you immediately start renting it for $2,500 a month, which is $30,000 a year. Well, you only had to deploy $60,000 of your capital to turn it into a $30,000 a year rental income stream,
Okay.
if you will, right? So there's this leverage ability that you can use mortgage debt to leverage the property and start getting cash flow from it. But here's where some of the risks come in, some of the cons. A lot of people overestimate their return on investment on their rental property, right? Because like you were alluding to earlier, you may be charging $2,500 a month on this $300,000 home and as a rent to tenants, but you have to pay the mortgage, you have to pay property taxes, you have to pay homeowners insurance, you have to do general upkeep, things like that. And so next thing you know, that $2,500 a month, maybe 2,000 of it is going towards all of these expenses. So you're really only netting 500 a month, right? Which is 6,000 a year, and 6,000 a year divided into the $60,000 down payment you made is a 10% yield, if you will.
Yeah,
now
that's
still higher. That's higher than you're going to get in dividend portfolios,
absolutely.
Right? But that comes with risks, right? If you have a tenant vacancy for a month or two, that 10% yield is going to drop substantially, right? If you have bad tenants who don't pay their rent on time or damage your property, whatever it might be, that's going to eat into your return as well. So that's, I think, what you were saying earlier, Danny, is like it's getting into that where you have to like deal with tenants and deal with repairs. It's starting to feel not very passive anymore,
absolutely.
Right? Like you're doing this work.
And
now,
if you're looking to achieve that highest yield, and you don't want to spend all of your money hiring handymen, you also are going to have to invest a lot of time both learning how to repair homes and also doing the repairs, which is, I think, one of the main aspects in which it will no longer be a passive income stream.
right.
And that's without dealing, like getting into the whole issue of horrible tenants.
Right. And a lot of people are attracted to rental properties because they like the idea of like, wow, I own this physical property, this tangible thing that I can literally charge people rent on. Plus there are some potential tax benefits with, depreciation and things like that. And plus a home can appreciate in value over time, right? But it's not right for everybody. If I had to like broad strokes, like who could a rental property be good for? Probably somebody who, like you said, Danny, is pretty handy and good at like managing repairs or at least has access to readily available people who can do that. Somebody who's good with tenants and happy to, work with them. Perhaps being in a good location or living close by. It's a lot easier to manage a rental property when you're right down the street.
Yeah.
As opposed to a different street, or a different state.
Not going to lie. It has crossed my mind. I have had some interest in buying a second home and moving into that home and then using my current one as a rental property. And in that case, in that situation, I would be looking within my same neighborhood, looking for a home within a couple blocks that we could move into as the new primary home and then rent this one out. It no longer makes sense with the interest rates that we have now. The numbers just wouldn't work out.
Yeah, and it may not make sense for everybody when it comes to looking at it as a passive source of income either. I do think, if people do the upfront work and they put in a lot of due diligence, and they really screen and find excellent, tenants who are very responsible, you could get to a point with the rental property where like you cruise along for a couple years and it's pretty passive, right? like I think that it's those good experiences that people will champion rental properties as being good passive income. But remember, there are also bad experiences in
there's
rental properties too.
there could potentially be some survivorship bias there.
Yeah.
You hear from the people that did make it, right? The people that have made it are the ones that preach about it, that reach out about things like that. A lot of the time when someone has something negative happen, or maybe an endeavor has failed, they don't talk about it as much. It kind of just like fades into the woodwork, right? So you might not hear about some of those struggles or failures that did happen and occur.
Right.
They're just not called out as often.
Yeah. Yeah. So I think those are all excellent points on this topic for rental real estate. Let's move on to the next one. I know this is one, Danny, that you're a fan of. A lot of people are. Mm-hmm. Much like passive income, this is very much in vogue. It's pretty popular, which is dividend investing. So what do we mean by that? Generally, when people are investing in assets that produce dividends, they're usually referring to having some sort of stock portfolio, or portfolio with ETFs or mutual funds that
or individual companies.
Or individual companies, yep. And living off of that dividend
mm-hmm.
income stream, if you will. So this one, it does require a higher upfront requirement because dividend yields, dividend yields are generally a bit lower than what you're going to see in like bonds or other asset classes. There are some that are high, but that could
There's
also
a lot of risk there.
Yeah, that could be a red flag. And just to clarify for our listeners, the idea here is that you would ideally not have to sell shares of these companies. You would just simply maintain all your shares and just live off the dividends that they spit out.
Yeah. In an ideal world, you'd probably have the dividend portfolio built to such a degree where you can live off a portion of the dividends, and some of them are available to reinvest to account mm-hmm. for any potential inflation in the future.
Right. Yeah, and to give you an example of how much more upfront money you need to be saving to have a large enough lump sum that the dividend yield meets your living expenses, recall on that 20% down payment example we just gave on the rental real estate, $60,000 to produce a hypothetical 10% yield, the $500 a month. You might need 5x that, right? You might need to actually put $300,000. If a dividend yield's only 2 to 3% on a portfolio, you're going to need substantially more to get the same income you might from other sources. But
that makes
that's
sense.
not necessarily a bad thing, right? I mean, if you are not selling any shares, then you're maintaining your holdings, and also the actual share price of your holdings, the actual companies you own, can also appreciate in value, right? In addition to spitting out dividends every quarter.
That's a good aspect to call out. I don't know how deep we want to go into it. However, the higher the dividend yield of either an ETF, a mutual fund, an individual company, the higher the dividend yield, typically the lower the chance of it actually appreciating, correct? Because so much of that capital and that revenue after tax is flowing out to the shareholders.
Right. I mean, and we should probably say too, Danny, to our listeners, a dividend is really just a company returning cash to their shareholders, returning earnings to their shareholders. That's a traditional definition.
Yep.
Now, whether the company is in a healthy position to do so is up for debate, right? If they actually have positive earnings in excess of all their expenses and they want to scrape some of those off and send them back to shareholders, that is that's the traditional use of a dividend.
Yeah, if you ever see that a company has to take on debt in order to continue paying dividends, that is a very bad sign. You don't want to see that. They need to have the free cash flow available to actually cover those dividend obligations. speaking of obligations, let's touch on the fact that dividend income is not guaranteed in any way from common stock.
Correct.
It can be canceled at any point. So there's a risk there that you have to be aware of. And if you're going to be living off of this far in the future, you need to have some kind of plan Bs in place to account for the potential that the dividend could stop, right? If it stops for a year or 2 years, where are you going to be getting that income that you have to live off of?
That's a great point. Dividends can be cut, they can be decreased, they can be canceled altogether. Not to mention, you are investing in the market after all, so there's also just simple market volatility to account for as well. So that could be stress, right? Stress that you may not feel in other sources of passive income.
A quick little comment I have about volatility. I do think that as long as you have invested in safe companies and well diversified ETFs and such, dividends, at least for me, do make it easier to stay invested in the market through volatility. Because I know as long as nothing has gone horribly wrong, those dividend payments will still keep coming through and increasing. Since I'm not drawing them down right now, will continue to increase my holdings.
Right, assuming that the companies continue to pay the dividends or don't cut them, which is a risk you're comfortable taking.
Absolutely.
Right? And there are companies who have demonstrated their ability and willingness to continue to grow their dividends over time. That's not a guarantee, but it certainly inspires a little more confidence than perhaps companies that don't seem to be committed to that. So there's a little bit there, but I hear you, right? Like if you're not worried about selling shares, especially if the market's down, that's where people get really stressed. It's like, I now have to liquidate some of these shares to meet my income needs. But if you've focused on having just the dividend meet your income need, then you don't perhaps feel as much stress as you might otherwise if you thought you might have to sell the share to begin with.
Absolutely. So one of the reasons I'm comfortable is my wife and I each have a 401k through our job. And then we have Roth accounts that are funded as well. And then the dividend account is kind of a bonus on top of that. Nice. It is in a taxable brokerage, so there are some taxes to be accounted for there. And it's not necessarily the most tax advantaged situation, but I'm okay with that. And I've kind of made that decision to move forward that way. Something that I often see people get confused about, and I want to call out right now while we're still on dividends. A lot of the time, I will see people ask, okay, well, I didn't take the money out, right? I just reinvested it, so I don't have to pay taxes on it yet, right? It's like, that is not the case. It doesn't matter if it was reinvested to purchase more shares, or if you physically took it out of your brokerage account. You received it as a payment from the company. You owe taxes on it. Don't ignore it. Don't forget about it. It's going to come back and bite you. You owe taxes on these dividends regardless of whether or not you reinvest them into the same company.
Right. That's a great call out. To put a little bit more of a positive note on that call out, though, and Danny, you and I have talked about this before. We're not going to go into detail explaining how things qualify for this, but there is a tax treatment available to some dividends called qualified dividend tax treatment, as opposed to just ordinary dividend.
It is a beautiful tax treatment.
It's essentially assuming that the conditions are met, and your dividends are qualified dividends, which we won't go into in this episode. But if it is met and they are qualified dividends, then they are essentially taxed at the same tax rates as long-term capital gains, which, again, we're not going to go into in this episode, but it's basically it's a little bit more favorable tax rate applied to it than ordinary income tax rates. It's different tax brackets that are a little bit lower. And for some people, it actually could be 0% tax bracket depending on their situation, although a lot of people don't fall into that category.
Okay.
All of that said, dividends are a popular topic for many people. Take a step back, more broadly speaking. We touched on it just a minute ago. Some people simply live off of their portfolio income from their investment portfolio, regardless of dividends, right? They may have a portfolio of all kinds of stocks and bonds of different flavors and sizes, right? And some may pay dividends, some may not. And this is what you would consider like a traditional investment portfolio. And in this situation, you are very likely selling shares to cover your living needs. It's it as opposed to just living off of a dividend yield. So, there is, in that regard, there's a lower upfront requirement than you would need for a purely dividend approach.
True.
Assuming that you're getting adequate growth from your investments.
Yeah, the goal there is that the capital appreciation, the growth of the entire portfolio outpaces the fact that you are selling off individual shares, right? So you're hoping
Right.
that the growth exceeds that depreciation in total number of shares that you're holding.
Right. Right. And so there are additional risks there, right? Like you're going to have to be selling shares to fund your living needs, and the problem with that is if the market is down, you may be forced to sell shares at depreciated prices, which you may not encounter if you were just leaving your shares intact in a dividend approach.
Yep.
But again, assuming that there's adequate capital appreciation from your investments, that you may not need as large of a portfolio as you would with a pure dividend portfolio. So, but yeah, it's, again, you're still subject to that market volatility that you would be with a dividend portfolio. Another approach that some people employ is buying individual bonds, for example, and laddering them. So like they might buy like I'm really dumbing this down to simple things, but to make it easier to understand, you might buy like a 1-year bond and a 2-year bond and a 3-year bond and a 4-year bond and a 5-year bond. And when the 1-year bond matures, you might use that to pay for that year's living expenses. And then your 2-year bond is going to come up to maturity, and you can use that money to pay for the next year's living expense. And then the 3-year bond, assuming you start at the same time, there are all kinds of bond strategies one could use. I'm just speaking in very basic terms. You could also, as opposed to bonds, you could do CDs, bank CDs, or even fixed annuities. There's something called multi-year guaranteed annuities, MIGAs, if you will. So bonds, CDs, MIGAs, whatever flavor somebody chooses, they could ladder these instruments to give themselves income. Some of the pros of this approach would be that it's predictable, right? Like, and in many cases guaranteed, right? Like if you're buying treasuries, right? Treasuries are guaranteed, U.S. treasuries.
We don't get to
CDs,
say that. We don't get to use that word very often.
yeah,
But
I mean,
yeah,
well,
as much as they can be. Yep,
yeah, as much
they
as they
have
can
the
be.
full faith and trust of the U.S. government is, I think,
Yeah,
how they phrase it.
the full faith and credit of the
Okay.
U.S. government, I think. Which, I mean, with the recent crisis when we weren't sure the debt ceiling was going to be lifted, I think some people were a little bit nervous, but luckily that all panned out. And then CDs, might have the FDIC insurance guarantee, and even fixed annuities, right? There are guarantees there from state guarantee associations up to certain limits depending on the state you live in. So predictable income, maybe have some sort of guarantee there. And the yield on those might be better than, say, dividend paying stocks, for example.
Yep.
So those are some pros.
Potentially a higher yield, but with zero chance of capital appreciation or growth.
Correct. But also, depending on the product, also potentially zero chance of any loss of principal
That's
capital
fair.
as well.
Yes.
Right. So it's, you might be foregoing some of that growth that you might otherwise receive elsewhere, but you are getting this kind of predictability and potentially better yield. Plus, you have a little bit of flexibility with time duration, right? Like the laddering, you can kind of have flexibility to customize what types of things you want to purchase based on certain years and when you want that income to be available. But that is also a risk we have to mention, right? So this is getting into interest rate risk or reinvestment risk, right? So let's say you buy a CD or a bond or something for 5 years, and during that time, interest rates go up a lot, right? So you might say, gosh, now I'm locked into this 5-year product.
Many
And interest
banks
rates,
experienced this danger recently. They bought very long-term bonds, and interest
yeah,
rates jumped. And when they had to
yep,
sell them, it was not good.
yeah. And so like as a personal, investor, as an individual, you might buy something for that requires a certain holding period of some amount of years. Interest rates could go up, and then you might be kicking yourself saying, "Gosh, I wish I had maybe bought a shorter term one, so that when it matured, I could have reinvested it sooner into even better yields." The opposite could also
Yep.
happen, right? You might buy a 5 year, but then rates drop tremendously, and by the time that 5 year product matures and you reinvest, rates are much less attractive then, and then you're kicking yourself saying, "Why didn't I buy a 10 year or a 20 year?" Right? But
Yeah.
you
And
can't
those
really predict
risks are
that,
higher depending on the duration, right? So a long duration
right?
bond, you're looking at that interest rate risk is much higher. Whereas with those shorter duration bonds and different options, the reinvestment rate risk is much higher because you had that shorter term and you're going to have to reinvest at whatever the new rates are when that term is up.
Right. Oh, and just to bring back a couple points we were discussing earlier, like how passive are some of these strategies, right? Like laddering bonds or CDs or fixed annuities or something. Like I guess once you get them set up, then you don't have to maybe touch them until some of them are maturing. But even then, that requires a little bit of diligence and paying
True.
attention to it.
I mean, I would argue that uh, dividend income investments and then these fixed income options, whether it's CDs, bonds, annuities, etc., are probably about as passive as it gets once everything's said and done. Again, as long as all of those initial investments and choices are sound,
Yeah.
they are about as passive as it can be.
Yeah, I agree with you, especially from the time commitment standpoint. Although I would say, like, maybe I might be stretching this concept here, Danny, but a psychological aspect of like how passive or is something when it comes to your stress levels. Like, I would agree that a dividend based portfolio is pretty passive, from a time commitment standpoint in many regards, but if you are constantly checking it or worrying about the market or wondering if you should have bought a different company over another, and next thing you're realizing, I may not be physically spending a lot of my working time or during the day attending to this, but I sure seem to be thinking about it a lot and experiencing stress. Maybe that's
That's
not so
fair.
passive there. I don't
I
know. It's just an
I
idea.
personally don't spend much time dwelling on it at this point. I have
Yeah.
it. It's kind of set and forget, and I have certain amounts that go
Yeah.
into every account, and it just does what it does.
I think this is where the subjective element comes back in, right? Like to all of our listeners, we have a couple more examples to go through, but so far from what you've heard, Danny, you said you don't really dwell on it or think about it. There may be listeners who would dwell and think on it,
Okay,
right?
that
And
is
I think
fair.
that's where the subjective part comes in. So you have to have you have to honestly reflect on your personal preferences and what style kind of meshes with you, with producing a quote unquote passive income.
Hmm.
Maybe that's rental property, maybe that's dividends, maybe it's CDs and bonds, some guaranteed type of thing.
Okay,
But I think
so
it's just good to be mindful of that.
sure, some people could be more stressed about it than I am. So in that regard, let's talk about guaranteed income sources, right? I know
Yeah.
you had brought up pensions and Social Security, et cetera. So let's dive into that. Perhaps those would be less stress inducing.
Yeah. I mean, this is I mean, truly about as passive as you can get, right? So there are traditional guaranteed income sources like a pension or a social security, and as guaranteed as they can be, right? Pensions can still fail, right? And there's a um, pension benefits guarantee. I forget the acronym. I should have looked that up before. I don't remember what it is, but there is a there are funds set aside, I think, with the government to cover to help with pensions that fail, but pensions are supposed to be quote unquote guaranteed, and so is Social Security. So this is truly just a guaranteed income that you receive for life, which there's no managing it required once you activate your pension or your Social Security, which can be a big decision, right? You can make a big decision on when to start your pension and what option to select. Is it just for your life, or is it just to cover you and your spouse's life? Same with Social Security. Should you take early? Should you take at full retirement age, or should you delay?
Yeah, and
that requires
there are a lot of details to get in there, and like the Social Security aspect, it depends on expected like life expectancy and how much you can
family
draw
situation.
from like when you first, what is it, 62 I think is the earliest you can ever withdraw, and then you can delay it into your early 70s
until age 70. Yeah.
Okay, I thought it had gone up to 72 at this point.
No, it's you can delay till age 70. There's no benefit yet to delay beyond that, but who knows? I mean, they could always change ages, right? With Social Security, that may be a solution they employ at a later date to extend the retirement age on Social Security if they think the Social Security funds are going to run out. That could be one tool they employ to fix it.
Nothing better than forcing everyone to work into their mid-70s, am I right?
So
no, thank you.
But I mean, it's this really is. I mean, it's at its most basic form. It requires no participation on your part other than making your selection, right? Once you activate it, it just goes on, and they may even adjust for inflation, right? Social Security has a cost of living adjustment, which is a nice benefit, so that helps the incomes keep pace with inflation. Some pensions have that as well, others don't.
For everyone listening, if you ever hear anyone refer to COLA, that's cost of living adjustment.
Yes. Yeah, good call out. Also worth saying that like pensions are not very common anymore. They were.
No, they are not.
They're pretty rare at this point. I mean, there are some government pensions, maybe even some state pensions, but they're more and more becoming a thing of the past.
A lot of police departments. I have a lot of experience in that. A lot of family members in that line of work. A lot of police departments do still carry pensions, and like you said, a lot of government agencies.
Right.
And the military has their own form of it, don't they?
Yes, yeah, there is. And I don't know a whole lot about it, but yeah, there are still pensions out there, but they are few and far between, right? Nowhere near to the extent that there were pensions like there were decades ago. They were much more common back in the day. Some of the risks though of these guaranteed income sources like pensions and Social Security, there's not really like an underlying asset pool that's growing in value. You may not be able to leave anything to your heirs, for example, right? Pensions generally stop when you die. It's not like there's generally not like a big lump sum waiting to pass to your heirs. Social Security, there is something called the survivor benefit. So if one spouse dies and they had the higher Social Security benefit, the other spouse can usually claim that as a survivor benefit.
Yep.
So that could be one reason somebody chooses to delay until age 70 to maximize their Social Security, so they guarantee like a larger survivor benefit for their spouse. But other than that, there's not really anything else that passes on to your heirs.
Yeah, that makes sense. Any heirs will have to pay taxes into that system for their working life, and then essentially accrue and then claim it on their own.
Right. And then, I mean, beyond that, most people who work in this country, U.S. citizens who acquire enough Social Security credits are eligible for Social Security after enough time has passed. And some people may have access to pensions, but other than that, there's not really any other way to replicate this guaranteed income source in the same flavor, if you will, with the exception of income annuities, which is an insurance product, and we can talk about that really quick too.
Because absolutely, that's what I was about to ask you about next. Because I know that there's a lot of controversy around annuities, and I've heard there's a lot of risks, like maybe unforeseen risks that aren't initially told to potential buyers.
It depends.
Okay.
And I hate using that phrase. It's the most common phrase in financial planners.
It depends.
All right. It depends. Yeah. So yeah, it's worth talking about this. They are a completely legitimate product, and for the right planning situation and the right person, they could be a very powerful tool.
Okay.
Full disclaimer. I've been in the financial planning industry for 8.5 years, going on 9 years. I'm not an insurance agent. Never have been. I've never sold an insurance product in my life. I've never earned a commission in my life on any of these. So I say that, take it for what it's worth. I'm not being influenced by some motive to talk highly about annuities. And I don't
down below,
commissions
you'll
on them,
see
so.
a link to our own annuity offer. No, I'm kidding. I'm kidding.
Oh my gosh. That would be a funny prank. But no, so I'm not being incentivized, right? And I don't have like a personal bias because I've never sold them, right? But
okay, that's fair. Good call out.
They're legitimate products, right? So they're actually probably the oldest financial product that's ever existed.
That's pretty
I've
amazing.
I've even read that you can date back thousands of years, even to like Roman times, and there were some form of annuities back then. And basically, what is an
That's very
this
surprising.
is where it gets complicated. I don't want this to become an annuity episode, so for our listeners, I'm going to try to keep this brief. There are so many different types of annuity products. We're not going to have time to go into them. I'm just going to focus on one, which is the old school traditional income annuity. It's where you give a lump sum to an insurance provider, and in exchange, they give you a guaranteed income stream for the rest of your life. And if when you die, even if you died the next day or if you lived until 110 years old, when you die, there's no money left over for your heirs. That's called a single premium immediate annuity, selecting a life only option. Now you can, in other products, you can select a cash refund where like anything left over goes to your heirs or your surviving spouse.
But all of those options necessitate a lower immediate payment. So each right. option you take, right. that I would argue makes the annuity more attractive and more enticing. Each option that you add on to it typically will lower your monthly guaranteed income.
Yeah, each option that makes it more attractive or enticing for the preservation of assets or increasing a survivor benefit to your heirs makes the income payout rate lower. But if your goal is to have the highest payout rate from an annuity as possible, then you would likely select a single premium immediate annuity with life only, right? So that's what we're talking about. And if you boil it down to the fundamentals, you're basically just pooling a bunch of assets from a bunch of different people. And the really cool thing about annuities is that they use actuary science. And I would bet many listeners have never heard of the term actuary science or actuarians. Actuaries, I should say, not actuarians.
I'm actually not familiar with that.
Yeah,
but
so
probably something for another episode.
It is, yeah. I won't dive into it. Okay. But essentially, these income annuities have higher payout rates for a lump sum, any given lump sum, than perhaps you would see in like even bond yields, at least on a guaranteed basis, right? Somebody in their 60s or 70s. I mean, you might see like you give them a lump sum. If it was a single life, you might see a payout of 6.5%, 7%, maybe more, depending how old you are.
Okay.
And it's guaranteed. And how do you do that? Well, there's something called mortality credits. A bunch of people pool together buying these annuities. The insurance company, using actuary science, knows what general life expectancy is. They also know that some people will meet life expectancy, some people will die before life expectancy, and some people will die beyond life expectancy. And the people who die early are able to subsidize the extended payments for the people who live longer.
They subsidize the extended payments for people, and they provide the profit for the company offering the annuities, correct?
There are a lot of factors that go towards profiting the company. That is one. It's good underwriting. Is good actuary assumptions do contribute to insurance companies' profits. But yeah, so essentially an annuity is making your own pension. That is literally all you're doing, basically. So for people who love pensions and Social Security and that guaranteed income, they don't have to worry about managing it, and it's predictable income. That may be an option for some people.
So I have a quick question. So listening to it here, annuities do sound good. And if someone is interested, would you say that if they are interested in an annuity, they should be speaking with a financial planner and not an insurance salesman initially?
This is tough. Okay. Obviously, I fall on the comprehensive financial planning camp.
Yes.
I'm a CFP practitioner after all, and I don't sell insurance. I never have. So it could be very easy to jump into that bandwagon and say like, yeah, like don't speak to any insurance agents. But
I just mean initially. I'm not saying that you can't go to them once it's been determined by someone looking at your entire comprehensive needs that you could go that route.
I'm not going to take a strong side here.
Okay.
What I would say is I have met many insurance agents who are incredibly skilled planners.
Okay.
And are very objective and put their clients first. I've also met many insurance agents who are doing nothing more than trying to sell as many insurance products as possible, and very little attention is given to actually matching a good product to the client's needs.
Okay.
And often are incentivized by commission. So what I would say is, do your due diligence. If you know somebody you trust, that's great. You could always get a second opinion by speaking to a fee-only planner who does not sell insurance. But also know that they're going to have their own biases, right? Like there's very much an attitude on the fee-only planning space, and that's a space I come from, right? Where you don't sell insurance products. There's very much an attitude there too of like that insurance products are all bad and generally not good for clients. So I don't know. I think if it makes sense for a client, that's when it's a good fit. Like it matches their preferences and it achieves their goals. That's what's most important. So yeah, I think that's all I'm comfortable saying on that.
Sure.
But
didn't mean to put you on the spot there.
No, it's tough, right? Because I have friends on both sides, so I want to be sensitive to being objective.
Over here trying to be Sweden or Switzerland.
Switzerland. I Swiss you wouldn't have said that.
I guess you had to sneak.
Did you like?
You had to sneak
like
one in somewhere, right?
I had to. I didn't open with a joke, so I had to sneak one in somewhere. Anyway, let's bring this back on track.
Yeah.
So to our listeners,
what's the summary?
Where do I start? What's right for me? What do I take from all of this? Right. Well, for any of you who are already well on your way, right? You may be high income earners. You may have little to no debt. You may have a good emergency fund. You may be well on your way towards financial success. For those listeners, I would say, think about what style of quote unquote passive income jives with you the most. Think about your own personal habits, your own preferences. Don't ignore those, right? Don't put yourself in a situation where you're feeling unnecessary stress because whatever solution you've crafted doesn't really fit with you well. And on that topic though, don't put all your eggs in one basket, right? Like diversify. There are many people who will have a mixture of literally every example you and I have covered today, Danny. I mean, there are some people who own a rental property and also have dividend paying stocks and also have an income annuity to cover some of their basic essential expenses and also use bonds, right? You can take different approaches. You can diversify in a way that meets your needs. And for our listeners who are just getting started, I would say start small. Think back to the emergency fund episode, right? Episode 3, I think it was. Get the emergency fund topped off. Here, I have a good personal story on this. So, I was looking at my bank account. My online savings account currently yields 4.4%, right? And I was like, wow, with the money I have in there right now, just the interest on a monthly basis is paying for my term life insurance and my wife's term life insurance.
Nice.
Right? Like, it's like cool. Like that was really motivating. It's like I don't have to like take money out of my earnings, my paycheck to pay for life insurance. Now my savings is just doing that. And that's a form of passive income, right? I could view it that way. I have enough lump sum in our savings account earning 4.4% interest that it's able to cover certain living expenses. I remember working with a couple once. The husband, they're both big into rock climbing, really big into rock climbing. It's super important to them. And they had enough money set up aside as part of their emergency fund. And I was like, wow, look at this. If you just put that in a high yield savings account and make that your emergency fund, the interest alone is going to pay for your rock climbing membership at your gym, which is like a super meaningful purchase to them. It's like, it's a really important life expense for them. Now that no longer has to come out of your income. Like these are small steps where like you can realize, wow, I was able to generate this quote unquote passive income to pay for this really important living expense. And just by starting small and realizing the effect that has, you can then zoom out and realize, wow, if I save up a large enough of a lump sum, I could start replacing more and more and more of my living expenses with this passive income. So
that's one way that I like to view it as well.
Yeah.
If we had a crazy emergency, our passive income is at the point now where it could pay for our food every month.
That's
I
awesome.
mean, that's if, eating the basics, very like affordable food, but it would be able to get us through some tough times. And that's a nice feeling.
Right. Right. And, it's going to be different for everybody, but I think think about your ideal future. What do you want to be doing? What kind of passive income fits your preferences? What style jives well with you? Look into them, explore them. Start with a percentage, maybe 4 or 5%, and then ask yourself, how much money would I need if something was paying me 5% to cover certain living needs? And that gives you, this is really basic. I'm not getting into rocket science here. And it can even be an arbitrary number, not tied to anything, but it can give you a starting point for a goal.
Yeah.
Look at where you want to go and
if you have a dollar amount that you need, let's just say it's 50K. I'm not sure what it would be for, but let's say you need 50K for the year. You can just divide 50K by 5%. And that'll show you what you need, right? What you need to reach in order to have that income.
Yeah. And, remember, just to reiterate this, passive income is loosely defined. It's used openly. It can mean whatever you want it to mean. It's an open concept. For me, and I think for you, Danny, I hope this isn't misrepresenting you, but for me, it represents financial freedom, right? It's this idea that I can set up enough money aside to pay for some living needs, and it gives me freedom to do other things in my life, to step away, to pursue other endeavors, and that's important to me.
Me as well. Long term, my goal is to have enough passive income so that my work is voluntary and I can work in whatever I am passionate about in, let's say, that decade, right?
Right.
I would like to be able to work because I enjoy it, rather than having to work in order to survive, essentially.
Right. Yeah. So I think that's a good place to let off, to stop for today.
To
our listeners, hopefully you drew some inspiration from this, got a better idea of what passive income might mean to you and steps you can take to get there. And we'll be here with you on that journey. And we look forward to seeing you in future episodes. And we'll see you next time.
And as always, have a great week.